You know, the craziest thing about Enron is that they were literally the darlings of America. They were featured on TV shows like Friends. You've probably heard the name Enron even if you don't know anything about it. The founders were called visionaries and heroes. George Bush called them innovators. Fortune magazine called them the most innovative company in America. But, unfortunately, that was all an illusion. Their whole rise was based on lies. Their financial statements were basically a fraud. At its peak, Enron was a $70 billion company. They were the seventh largest in the United States. They operated in more than 40 countries across 5 continents, and they were doing all sorts of crazy things. Like Enron offered broadband internet access in India. It was one of the first U.S. companies to do so. But unfortunately, it all turned out to be a mirage. In October 2001, Enron fired 4,000 employees. Soon after, a whistleblower sent a memo to CEO Jeffrey Skilling. He said that he was worried about the company's finances. Now, this guy was not some low-level employee. He was the head of Enron's broadband division. So he knew what he was talking about. He said that Enron's accounting was wrong and that they were hiding losses. His memo contained very specific details about exactly how they were inflating their revenues. It was very well written. So what did CEO Jeffrey Skilling do? Well, he forwarded the memo to the company's chief accounting officer and wrote, "Mark to market is fine. We have to stick to our guns." That's right. Instead of investigating the claims, the CEO just forwarded the email to the company's chief accountant and said, "Hey, ignore him. He's full of crap." What happened next shocked the entire world. When Skilling forwarded the memo, he actually copied Sharon Watkins, the author of the memo, on the email. When she saw the CEO's response, she replied, "This was supposed to be a confidential discussion, and I feel very uncomfortable that my message has been CC'd to you, especially since you indicated your intention to personally look into the matter." So Skilling responds, "I didn't mean for it to go to you. Sorry." The story could have ended there. But instead, Sharon decided to take matters into her own hands. She started digging through the company's financial records and found out that Enron was reporting $1.2 billion in profits. But in reality, they were losing $1.2 billion. Everything was reversed. That's why we have negative revenues here. According to Gabe, Enron would have reported a loss of $969 million, but instead they were reporting a profit of $1.2 billion. So if you combine the two, that would be a profit of $2.2 billion. That's why we have revenues down here. So in reality, they should have been reporting a loss, but they were reporting a profit. Basically, they were saying that they earned $2.2 billion when they actually lost $969 million. And the craziest part is that this was just the tip of the iceberg. Enron used a combination of accounting tricks to make themselves look far more successful than they really were. And the main trick that they used was called mark-to-market accounting. Let me explain. Normally, when a company makes sales, they record the transaction at the point of sale. So let's say I buy a car from a dealership today, then the dealership will report that sale on their income statement today. But when it comes to certain types of contracts, companies are allowed to report the transaction as soon as they make the deal instead of when the sale actually happens. For example, let's say I'm a farmer and I sell corn futures. It's a contract where I agree to sell 1,000 bushels of corn at a set price on a future date. Now, in accounting, this contract is recorded at the point of sale. So I record the sale on my income statement immediately. Even though I haven't delivered any corn yet, I've already earned the money, right? Wrong. Maybe the corn will rot. Maybe the price will drop. There's no telling how much corn you'll be able to sell in the future. This is why many farmers choose to hedge, which means they enter into contracts to buy back some of their corn at a later date. That way, if the price drops, they still have a guaranteed buyer. This helps smooth out the ups and downs of the market, and it allows farmers to plan for the future. But sometimes, farmers get greedy. Let's say the price of corn is currently $5 per bushel and you sell corn futures for $5. Then, a week later, the price drops to $4. but you want to report the sale at the current market value. So you ask the buyer to record the sale at $5 and pocket the difference. And if that's okay, then why isn't it okay for a giant multi-billion-dollar corporation to do the same thing? Well, it's not. Unfortunately, Enron got away with it because they had some friends in high places. The executives at Enron realized that they could use mark-to-market accounting to inflate their earnings. All they needed was a little creative help from their accounting team. So they created dozens of fake shell companies. These were called Special Purpose Entities, or SPEs. The SPEs existed solely to move around Enron's debt. Then they sold off these fake shell companies to outside investors. Since the shell companies had no debt, they looked extremely healthy. So investors were happy to buy them, of course. They didn't know that they were buying Enron's debt. Enron claimed that they sold these companies for fair market value, but really they were just moving their own debt to different parts of the balance sheet. The SPEs were often managed by Andy Fastow, Enron's chief financial officer. He made such a mess of things that Congress held hearings to investigate whether he was a genius or a fraudster. In the end, they concluded that he was both. While Fastow was busy moving Enron's debt around, the company's auditors, Arthur Andersen, were turning a blind eye. You see, Arthur Andersen had a cozy relationship with Enron. They had access to the company's bank account and they approved almost every single transaction. They also had a financial interest in Enron's success. Arthur Andersen owned 25% of Enron's stock. To make matters worse, Enron paid Arthur Andersen $52 million to audit their books, but they also paid them another $80 million for consulting services. So it wasn't in the best interest of Arthur Andersen to piss off Enron. And what's even more ironic is that Arthur Andersen was the company that eventually exposed the scandal. I mean, that's what they do. They audit financial statements and find errors. But, in this case, they had done such a bad job auditing Enron's financial statements that they couldn't destroy the company fast enough. By September 2001, it was clear that Enron was in trouble. The SEC launched an investigation into the company, and their auditor, Arthur Andersen, tried to figure out what happened. It turns out that Enron had hidden billions of dollars in debt and inflated their earnings by billions more. It was one of the largest corporate frauds in American history. On December 2, 2001, Enron declared bankruptcy. Their stock, which had traded as high as $90, collapsed to just 25 cents per share. Thousands of employees lost their jobs and investors lost over $74 billion. And when the dust settled, 5 former executives were charged with crimes. 2 of them went to jail, including CFO Andrew Fastow, who served 6 years. The fall of Enron had a major impact on the world of business. It led to the creation of the Public Company Accounting Oversight Board, which is responsible for overseeing audits of public companies. It also led to the passage of the Sarbanes-Oxley Act of 2002, which strengthened corporate governance rules. As a result of this law, CEOs are now required to personally certify their financial statements. Additionally, the law created the position of Chief Compliance Officer in order to ensure that companies are following the law. The downfall of Enron wasn't just a loss for investors and employees. It was a blow to the reputation of the entire business community. The company was once hailed as an innovative and dynamic leader. But in the end, it turned out to be a fraud. The scandal led to a loss of public trust in corporations and heightened calls for greater regulation. Today, Enron serves as a cautionary tale of what can happen when greed and deceit go unchecked. If you liked this video, please smash the like button and subscribe to our channel for more related content.